here we are. Brandon, welcome. I want to make mention here that Brandon here is shown to be equal to me, but in actuality, he is taller than me. That is just a genetic error, but it's probably worth mentioning. So we're going to go straight to the program. We have some people on the program we know who are not experts on estate tax, but you probably do know that the estate tax exemption right now is 11,700,000. It would only be 11,580,000 if you went back in time and you were in 2020, or if you had made a gift of $120,000 and that was counted against your exemption, in which event your exemption would now be $11,580,000. There is a marital deduction. If I die and I leave assets directly to my spouse, then those assets will not be subject to estate tax in my estate, but they will be subject to an estate tax in my spouse's estate. Now, if I leave all my assets to a trust that can benefit my spouse without being subject to tax in her estate, that's going to work much better. But if I don't use my entire estate tax exemption, then the part I don't use will go to my spouse, and my spouse will be able to leave more when my spouse dies. For example, I have an $11,700,000 exemption. I die, I leave $3,700,000 to a trust for Marcia, which benefits her and is never subject to estate tax in her estate. I didn't use $8 million of my exemption. Now Marcia has an exemption, not of $11.7 million, but of $19.7 million because of the portability rules. But now Marcia marries the pool boy, and the pool boy wins the lottery. And when he dies before Marcia, maybe arsenic, maybe not, the assets pass to his children. Now Marcia has lost my $8 million portability allowance, and she lost the pool boy. So portability is not always so good. Also, it doesn't rise with inflation, and it's not eligible for generation skipping tax. So a little bit more background. When one spouse dies, we would like to leave the amount that can pass estate tax free to a bypass trust that will benefit the surviving spouse without being subject to estate tax in the surviving spouse's estate. Brandon, how does the life insurance work, both under the law as it is today and under the law as it would be after the September 13 House Ways and Means Committee bill is passed, if it is passed?
Yeah, so under present law, you can put life insurance into a special type of irrevocable trust, and as long as you live for more than 3 years, that policy and the death benefit's going to be outside of your estate. So a lot of clients do that. You can pay premiums each year, maybe by making gifts to the trust, using potentially annual exclusion gifts, where if there's 4 beneficiaries of the trust, you can contribute $15,000 per beneficiary. So you could put $60,000 in there each year that might be able to use to pay the premiums on the life policy. Or you can do what is known as a split dollar loan arrangement, where you essentially loan money to the trust to pay for the premiums, and then upon your death, the death benefit first goes to pay back that loan, and then the excess can pass to the trust for your spouse or your children. So that's pretty commonly done to get life insurance outside of the estate. The issue with these types of trusts are most of them are considered to be grantor trust. And if this law passes, we can no longer have transactions or make contributions to a grantor trust, because if we do, then it loses its grandfathered status, at least to the portion of contributions made following the effective date of this bill. So if you had $1 million or in the life insurance trust, and you make another $1 million contribution into the trust, then 1/2 of that trust is going to be considered as included in your estate by reason of being a grantor trust with contributions made after the effective date of this bill. We don't know if that's going to be the case. Life insurance has a really good lobby, and they usually get a little bit of benefit from Congress a lot of times in these types of new proposals. So we'll see if they have specific exemptions for life insurance trust, maybe funded with crummy withdrawal powers and annual exclusion gifts. But it'll be interesting to see what happens with respect to life insurance planning after the effective date of the bill, if it does pass and life insurance is not exempted.
Right. Life insurance is the sacred cow that gets milked by Congress for lots of lobbying and lots of campaign contributions. So I think a lot of times the congressmen just like to throw these anti-life insurance proposals into the law so that they can get even more contributions, and life insurance usually comes out great. But if you have a permanent life insurance policy in a life insurance trust that is disregarded for income tax purposes, just know that after this law passes, if it does pass, you'll still be able to loan money to the life insurance trust under what we call the split dollar loan regime, where you pay the premiums and the life insurance trust agrees to pay you back the premiums with interest at a very low rate, and there's no payments owed until the insured dies. What's going to be difficult, though, is if you have term life insurance. Term life insurance is much more inexpensive than permanent life insurance, as I'm sure you know, and life insurance companies will be more profitable if more people buy permanent as opposed to term. So maybe they're willing to let term life insurance not work well under life insurance trusts. We will see. Again, I don't expect that this part of the bill would pass, or I'm pretty sure they will safeguard life insurance.
Yeah.
Now,
one comment there, Alan. Some planners are recommending that if you do have kind of a term policy, or that the trust doesn't have enough cash to pay premiums, that you would go ahead and make a gift today to that trust and almost try to pay up the life insurance policy, so you wouldn't have to make future contributions and mess with the grandfathered status of the trust. So that's another idea that's being thrown around out there, but we'll just have to wait and see what comes down with this statute.
Right. Now we have a question as to what the effective date of the new statute would be. And I had 2 or 3 emails this week saying my advisor or my friend told me that these estate and gift tax changes would be effective back to September 13th. And that's not the case. The September 13th proposed rule said that capital gains and the sale of certain companies called Section 1202 companies would be effective September 13th. So if you had a closing and you sold real estate September 13th or thereafter, even though the bill hasn't been passed yet, when the bill is passed, those capital gains may be taxed at 25% instead of 20% as the highest rate. And the Section 1202 sales may have a 50 or 75% of otherwise applicable rate as opposed to a 0% rate. But Brandon, other than that, can you think of anything that would date back to September 13th?
Yeah, I think those were the 2 big ones that I recall. The capital gains being the most important. The one exception there, if you had a binding contract, even though if the sale closed after September 13th, if you were under contract prior to September 13th, then you would still have the lower capital gain that previously applied to that transaction.
Okay, so Brandon, let's say that I did an installment sale last year in 2020, and I am receiving payments every month of principal and interest.
Mm-hmm.
Once this law passes, does my principal that I get paid next year from a 2020 transaction get taxed at 20% or 25%?
Yeah, so they would continue to be taxed at 20%, even though the new rate is 25, because of the fact that that transaction was entered into prior to September 13th under a written contract. Now, it had to be a binding written contract, and you would have to have probably a note that was written to reflect the terms of that deal. They couldn't just be a handshake type transaction, the IRS is going to want to see some substantiation on that. So, go ahead and document those types of things if you haven't already.
Okay, very, very good. All right, if we had a polling question, and if you send us an email with the letter A, B, C, or D, then we'll send you what you're requesting. Just put it in the RE line. A free subscription to the Thursday report, our article on spousal limited access trusts. C would be both of the above, and D would be a spinal tap, which would probably not be as bad as watching this entire webinar. Okay, page 14, as we warm up your minds, client and client spouse have $20 million worth of assets, which they cheerfully put into a limited liability company. Get that limited liability company formed really quickly and get it up and running and get those accounts moved into the limited liability company. If it's going to take a while, have a nominee agreement signed where the clients say, we hereby assign all of our right, title, and interest to that Merrill Lynch account, which has our stocks and bonds in it, to ABC LLC, and agree that we're holding these assets for ABC LLC, and then we're going to transfer them formally to the LLC just as soon as we can. Okay, then we like to wait about a month, and after about a month, we can have the client transfer a 49.5% non-voting member interest to a trust for the client's spouse and descendants, and we can value that 49.5% interest at a discount. So 49.5% of $20 million is just under $10 million. But if you were to assume a 30% discount, which would not be unusual, then in exchange for this interest, we could give the client a $7 million note. Now, to give the trust economic independence, we would recommend a $700,000 seed capital gift. So that is your SLAT, your spousal limited access trust. On the other side, the client's spouse forms a trust for descendants with a $700,000 seed capital gift, takes back a $7 million note. Now, the note can bear interest at the applicable federal rate. The long-term applicable federal rate is just under 2% right now. So now what have we done? We've changed 20 million of assets into $14 million of notes. We've gotten $7 million out of the estate for estate tax purposes. If it looks likely that the 2013 law is going to pass, the September 13th law is going to pass, then the notes can be forgiven. And those notes should be forgiven as gifts to the trusts well before President Biden signs the act. And well before means 2 or 3 days before, so no one has to stay up all night organizing all of our clients who have this situation. Everybody needs to be ready. If it looks like this is going to pass the Senate, then we'll be sending our clients note forgiveness documents and calling them and emailing them, sending carrier pigeons to their homes, faxing, sending telegrams, everything we can. Because if this note is not forgiven before President Biden signs the law, then in order to make a gift exceeding your half of your 11.7 million amount, which is what you may want to do to use it rather than lose it, you'll have to give that gift to something or someone other than the trust. What you give to the trust before the law passes can safely stay in the trust and be disregarded for income tax purposes and kept out of the estate. Brandon, any clarification for that?
Yeah, no, I think that's the important part is, as you know, if we're doing the Biden two-step, as we called it, where we would first sell assets and then later potentially forgive the note if the estate tax exemption is going to be reduced, so we can use the increased exclusion. That's going to be done to that grantor trust. It has to be done prior to the date that President Biden signs the law. If it's done afterwards, then you've made a contribution to the trust and would cause a portion of the trust to be included in your estate. So we want to make sure we keep an eye on timing of all this and when that forgiveness of the note or gift to the trust is going to occur.
Right. Now I see a question, Brandon, and I'm going to let you answer it. And the question is, why aren't you doing two slats? Why is client doing a slat and client spouse is only doing a descendants trust? And the answer is not because the spouse doesn't want to benefit this client. Although I don't, knowing this client, I wouldn't blame the spouse for not benefiting him. But Brandon, what is our answer for this?
Yeah, so the answer there, it has to do with the reciprocal trust doctrine. So if spouse one creates a trust for spouse two, and then spouse two creates a trust for spouse one, they're reciprocal trust because they could each benefit from the other. And then under the estate tax law and also state law for creditor purposes, each spouse is essentially treated as having set up their own trust. So that would be a self-settled trust and therefore could be accessed by creditors. And if a creditor can reach into the trust when we have a reciprocal trust, then that trust is included in your estate for estate tax purposes. Now, there are some planners that do reciprocal trust and reciprocal slats, but they draft them in a way to make them non-reciprocal. So there's different terms, there's different distribution standards, there's different remainder beneficiaries, there's different trustees. There's a tax court case that says that could be done and okay for estate tax purposes, but that case didn't address state creditor rights and whether state creditors could reach into that trust, which is a whole nother issue that could cause estate tax inclusion, and it wasn't addressed by this case out there. So we're not comfortable with it. If the client is concerned about getting assets back or running out of money, then the trust could be put in Nevada or another asset protection jurisdiction, and the client could be added back in as a beneficiary of that trust if certain events occur. So we think that's a lot safer than doing the we call them non-reciprocal slat trust, just because of those state law potential issues.
I think you said that absolutely exactly right. Now, here's another question that's come up. How is the client protected from divorce? Well, none of us are protected from divorce. Your spouse can always divorce you, and maybe you deserve it. But the client's spousal beneficiary trust here can provide that in the highly unlikely event of divorce, that's normally what we put in the documents, whether it's true or not. In the highly unlikely event of a divorce, the spousal beneficiary trust can do one of two things depending upon what the situation is. If this is a second, third, or fourth marriage type situation and the assets going into the spousal beneficiary trust are really the separate non-marital assets of the client, then in the event of a divorce, the spouse is simply considered to no longer be living, and the trust assets are held for the children of the client and maybe for the benefit of the client's next spouse, which we call a floating spouse. It has nothing to do with how they look in a swimsuit. It's that if one spouse goes away, the next spouse comes aboard, and the client would like indirect access to the trust, well, the next spouse becomes a beneficiary during that second marriage, or third, or fourth, or fifth, or sixth marriage, or you could be Henry VIII, and then you have the indirect benefit. On the other hand, when I told Marcia about the floating spouse provision, she was not so good about it and said, yes, over my dead floating body. So what my slat says is that in the highly unlikely event of a divorce, the slat turns into two separate trusts. The first one is a continuation of the existing slat for Marcia's lifetime health, education, and maintenance. And the second one is a separate descendants trust. I control who the trustee is, and it is for our daughter and our daughter's descendants. So I'm still out of luck. Although it's a Nevada trust, and my friend, the Nevada trustee, who I may choose as successor trustee, may have the discretion to provide me with benefits if my net worth goes down to a very low level, which would certainly be the case if I ever got divorced. So that is installment sale 1 of 2. Page 15, the happy ending. The assets double in value. That's happy. The LLC liquidates, perhaps. And what happens? Each trust is worth $13 million, and the 2 spouses are still worth $14 million. So you've moved all that growth out of their estate, and they've used their annual payments to pay the taxes on the income recognized by these trusts. So it works very well. Brandon, you weren't here last week, but I want to just show you these slides. I went over them last week. I'm not going to spend as much time this week, but here's a client. We'll call him Jay because he doesn't follow the rules. He often jaywalks. So he has closely held stock worth $11 million, and he wants to form a slat before it's too late. So he forms a slat. He puts it in Nevada because he wants to get let back in if his wife ever leaves him. Not that she ever would. And he puts the $11 million into an LLC, gives the LLC to the slat. The wife is the manager of the LLC. Now the Nevada trustee can't steal anything other than the $5,000 account in Nevada. And the gift tax return shows an $11 million gift. Now, he's not taking a discount at the LLC level. He didn't want to do that. But one reason for the LLC in Wyoming, besides the fact that it helps us increase our fees, is that his gift will be by use of a formula clause. And the formula clause will say, I give the greater of 100% of the lesser of 100% ownership of this Wyoming LLC, or a percentage of ownership equal to no more than 11 million. So if it turns out that the Wyoming LLC is worth 22 million, then he's only given 50% of that. In the meantime, the company that he owns part of, which wants nothing to do with a formula clause, is happy because they know it's all owned by the Wyoming LLC. So that's alternative 1. Alternative 2, if there's time, is he puts the $11 million into a Wyoming LLC, and then he waits 20 to 30 days because of the step transaction doctrine, and then he transfers a 99% non-voting interest to the slat and reports it as a $7,700,000 gift because of a 30% discount. He does now have to pay for a valuation report, which may cost between $3,000 to $6,000, depending on where you get it. But he has saved $3.3 million in estate tax exemption. And we do show that it's safest to have a separate trust established with a different trustee who has the power to determine if and when the LLC will ever dissolve or make a liquidation or a distribution because of Internal Revenue Code section 2036, little a in parens, 2 in parens, and the Powell and Strange cases. So this, I think, is a better alternative. The third alternative, Brandon, is instead of gifting it, he's not sure he wants to gift it. He's not sure President Biden will ever get to sign a bill like this. So he takes back a $7 million promissory note. He's only made a small gift here of the seed capital gift of $770,000. If the Republican Party is able to get back into control and eliminate estate tax forever, he's put less into the slat. On the other hand, just before President Biden signs the bill, he could forgive the $700,000 promissory note. Brandon, any words of wisdom, questions, or suggestions on this?
Yeah, no, I think these are really good slides to just lay out the 3 possible alternatives there. A couple of questions that I see related to this is how does this work for the interest payments? Are the interest payments taxable when made from the trust? And the answer to that is no, because this trust is set up as a grantor trust, which is disregarded for income tax purposes. So Jay here is actually treated as the owner of that trust. So Jay in this installment sale transaction is really just treated as paying interest to himself, which isn't taxable. Same thing even if these are appreciated assets that are sold, that's not going to be taxable either. The catch here and why we're so busy and in so much of a rush to get all these things done is if you do this after the effective date of the bill, then the interest becomes taxable, the appreciated assets become taxable. So it would be a lot harder and not as beneficial. There's still some benefits to it, and we have some slides to show that it can still work for estate tax planning after the effective date, but it's just not as good as it once was. So that's why we're in such a rush to try to do these things.
Okay, we've got some really good questions here from the estate tax lawyers. One, what would you do if the closely held stock was an S corporation? An S corporation can't be owned by an LLC. Well, technically it can. There is a private letter ruling, and the law is pretty clear that an LLC owned by J and owned by a defective grantor trust established by J and owned by a separate defective grantor trust established by J is disregarded for income tax purposes and can therefore own S corporation stock. But we prefer not to take the risk that Jay may forget about this situation and have a friend or wife buy a tiny percentage of ownership in the Wyoming LLC, which causes it to be taxed as a partnership, which causes loss of the S election. Even though that would probably be an inadvertent termination of the S election that could be fixed retroactively after a lot of worrying and nail biting, there is that possibility. So that's just one consideration. Another question is, why can't Jay be the manager of the LLC? Well, his wife doesn't trust him, that's why. Actually, Jay could be the manager of the LLC. I think for the IRS, it's better window dressing to have Jay's wife as the manager. But for a lot of clients, that reptile brain requires that the client be the manager. There's nothing wrong with that as long as the LLC has plenty of fiduciary language in the operating agreement. Jay's held to a high fiduciary standard, and Jay should not borrow money out of that LLC without a promissory note and arm's length interest. He shouldn't pay any personal expenses out of the LLC. That needs to be held separate and apart from Jay. You know, a lot of clients ask me, why are you doing the installment sale for a note? Well, one reason is that next year, when the client files the gift tax return, which we can assist with, they may not want to report the gift. If you do the straight transfer of the LLC interest here to the SLAT, then you've clearly made a gift of a discounted interest, and the gift tax return is going to disclose that. On the other hand, in this alternative, if I made a $770,000 gift to the SLAT and I got back a $7 million note, then my gift tax return only has to disclose the $770,000 gift and later the forgiveness of a $7 million note, but it doesn't have to disclose the sale of the discounted Wyoming LLC interest to the SLAT in exchange for the note. Now, it's a good idea to disclose it to get the 3-year statute running on the ability of the IRS to challenge it. But quite frankly, a lot of clients don't want to get audited, and they'll just leave that for their children to worry about, and they don't want to pay as much for an appraisal. So those are all things to consider. Now, the applicable federal rate chart, I wanted to get tiger tables up today. People are asking me, how do you do all these calculations? Every month, Brandon and I just can't wait to receive the applicable federal rate report and the applicable federal rate for October. is 1.74%. So I could sell assets to a trust for a 20-year note, and for that 20-year note, I can charge 1.74% on any note over 9 years, and I can fix the interest rate at 1.74%. In a sale, I can use the lower of this month, last month, or the month before. So if I do a sale, I could report the interest rate at 1.73%. And by the way, this is compounded annually. No one's sure why it's compounded annually, but that's the way it works. Now, if I do a note for 9 years or more than 3 up to 9 years, the interest rate only has to be 0.91%. And a note of 3 years or less, the interest rate only has to be less than 1/5 of 1%. So here's our 73-year-old client. Here's a trust. He could sell assets for a long-term note at 1.78. These were the rate. Here I'm showing you the rates from April. But here's all the possibilities. Now, a 73-year-old has a 12-year life expectancy. So instead of a note that would bear interest at 1.98 entered into in April, he could have done a 12-year note bearing interest at 6.2%. And then if he died during the 12 years, he would not have to include the note in his estate for estate tax purposes. So when a client is in poor health, you think about a self-canceling installment note. The IRS doesn't like them, but if the person is of certain health, you could set up a skin. The alternative is a private annuity. Here, this 73-year-old client, let's say he has $10 million and he never wants to pay estate tax, and he spends $860,000 a year. Well, this is great. He sells $10 million worth of assets to a trust or his children in exchange for an $860,000 a year annuity payment right. When he dies, there's no more payments and there's no estate tax. If he lives a long time, he just keeps spending the $860,000 a year. Now, to sell assets to a trust for an annuity, you have something to worry about called the minimum capitalization rules.
The probability of exhaustion.
Yeah, the probability of exhaustion test. Sorry, I'm exhausted and forgot the name of it. So you would
high probability right now.
Yeah, for a 73-year-old, you'd probably need about 20 million worth of assets in that trust to pass the probability of exhaustion test. So let's take a short break here with a polling question. Which book would you like to receive a PDF of? And if you, whatever you choose, we'll send you one. Just send us an email, free book, our 8 steps to a proper Florida trust and estate plan, B, a practical guide to kickback and self-referral laws for Florida physicians, C, creditor protection for Florida physicians, and D, what estate planners need to know about bankruptcy. We'll be glad to send that over to you. All right, so now what I promised I would do for some of you is let Brandon show us how Tiger Tables works. So Brandon, I have Tiger Tables here, and I'm going to start off by showing something that I think is pretty neat on Tiger Tables, and that is the tab for probability of survival, and first, life expectancy. So I am 62 years old, and I would like to use the current mortality table, and I'd like to know what my standard life expectancy is of a 62-year-old American, and that is, ooh, I don't even have 20 years left. I have 19.99 years. Now, I don't feel so bad because the average American, a lot of them are smokers, a lot of them are obese. I'm not either of those things, so I'll probably live a little bit longer than 20 years. But another curiosity, let's say that Marcia is 49, because she's been 49 a long time. And how long will it be before both of us are gone? The second to die. And we're going to go 32.95 years. So that pool boy is going to have 32.95 years. Now, what if she goes it alone? What's a 49-year-old? How long will a 49-year-old live? 30.76 years. So, Brandon, where do I go now to determine what the interest rate on a skin would be for a 62-year-old?
So under this miscellaneous tab, they have the ability to do self-canceling installment notes. So you would put in the current interest rate here of 1%. If we were doing a note for Alan's life expectancy of 20 years, we would have to use a higher rate than the 75/20 rate. We would have to use the long-term AFR. So we're looking at a 19-year note, and let's just say it's an even 2%. So we don't have to worry about the fractions. So Alan is 62. Now the nice thing about Tiger tables here is if we try to do a 20-year note, it's going to give us an error because that's longer than Alan's life expectancy. So it has some nice fail-safes to stop us from doing things that we can't do. So 19-year term, he sells $1 million or $100,000. He has low basis in the assets, which is going to be irrelevant for our transaction because it's going to be made to a grantor trust. So there will be no income taxes. So we can do interest only notes and get our results with the interest premium. So here, the premium that we have to charge due to the fact that there's higher risks because this note can cancel if Alan dies prior to his life expectancy, a little bit higher than market interest rate is charged. So 1.789 is the premium. So we could do this transaction for 3.789% interest and sell assets to a trust in exchange for a self-canceling installment note.
Okay, so can we go back to one screen?
Yep.
Okay, so the interest rate is the 75/20 rate that you have to put there, which is now 1%. Correct?
Well, that's the 75/20 rate, which helps calculate that premium, but the market rate that we would have to charge to add to the premium would be the long-term AFR.
Right. So the top box, you put 1%. You look up the 75/20 rate on the internet, and you put in 1%. Then the actual right now, it would be 1.76%, which is the long-term applicable federal rate. And then can I say 19.9 there, or won't let me use decimal?
Just even, yeah, it's just even years.
Okay. So,
and then click on the results with interest premium tab here.
Got it. And that again shows me that the interest premium here is 2.029%. So if I'm going to spend that money anyway, or I feel like I've given too much away, or I'm not in great health, that makes sense. Now, Brandon, Professor Hesh has told us that you can actually go longer than life expectancy with a self-canceling installment note. The interest rate goes up, which some clients would actually like, but how do you calculate that?
Yeah, so it's all based upon really present value factors. And for a 20-year note, you have to essentially factor the present factor arrangement and the probability that you would pass away in a given month for those 20 years, or however the 25 years that you might want the rate to go for, and then average them all together and do another multiple. And so it's a quite complicated math formula arrangement, but it can be done. You just have to be familiar with the way the skin is calculated, familiar with present value factors, and know how to look up those values on IRS tables. So it's complicated, but can be done.
Okay. So now I'm going to Qualified Personal Residence Trust. I've put in the 75/20 rate that I got from the internet, which is 1%. I'm going to do a one life Qualified Personal Residence Trust. I'm age 62. I'm going to be able to live in the house rent-free for 12 years. After the 12th year, I'll have to pay rent. The house is worth $1 million. I'm going to use the current mortality table. I'm going to click recalculate. And what does this tell me? This tells me that my transfer of this $1 million house into the Cupert is a gift of only $692,000. So my ability to live in the house rent-free for 12 years, according to the IRS, is worth $307,000. Now, if I move out of the house and use it as a rental property, or I sell the house and reinvest it, then this Cupert has to pay me $30,137 a year for whatever remains on the 12-year term. So now you can take these numbers and plug them into this spreadsheet that we've made available to everybody, whereby, oh, Brandon, you have an income tax analysis here. That's interesting. So you want to, well, let me go back to this. So again, just on Tiger tables, I say, well, I don't want to make a $692,000 gift. I think I'll definitely live 15 years. So I move that number to 15, hit recalculate, and now my gift is only $597,000. So now I go to our estate view chart. And how does this work, Brandon? I can put in $1 million here.
Yeah, on the far right hand side, you should be able to still have your tickers. You can,
okay, but
I have to undo the last. If you close it and reopen it without saving it, you can probably just use the clicking mechanisms.
Well, let's just pretend it worked.
Okay.
So you have a state view Cupert chart, and here I would show the value of the home at $1 million. And sorry, I guess I can make it smaller there. So I want to click the value of the home to $1 million. Oh, it's not working right now.
Yeah, because when you entered in manually the number there, it messed up the formula. So the clicker's not going to work.
Okay. The moral of the story is I should never touch anything. That seems to have worked. And then we said that the Cupert length, we went, what, 12 years. So this is pretty much how it looks. You have a home that I'm using rent-free. It starts off worth $1 million. It's growing at 3% a year. By the time I get to year 20, it's worth $1.7 million. If I pay 8% rent on the value of the home beginning in the 13th year, then you see the rent is storing up. The rent reinvested at 7% after taxes. And then you see the use of my estate tax exemption, we said was about $600,000. So that should have changed everything, but it didn't. Anyway, the estate tax savings is nice. But Brandon, tell us about your new income tax analysis.
Yeah, so one of the clients that we were, trying to set up a Cupert for had a question, and they said, well, I paid $1.6 million for my $2 million home. So let's just put in $2 million here to see how that would work. So I don't have to, we'll stick with $1 million and just change the basis. So they paid, let's call it $700,000 for this $1 million home. And their question was, quite likely the IRS is going to argue that I lost my step up in basis on my death. So, and then my son lives in California, subject to a 13% state income tax. The 3.8% tax is going to apply. The capital gains rate might increase to 25%. So I could potentially be paying income taxes at 41.8% on my death if they sell this home. So how are we doing anything here? We're paying 41% income taxes, but only saving 40% in estate taxes. Does this make sense? So we said, well, remember, income taxes only apply to the extent that you have gain. Estate taxes apply on the entire value of the property, regardless of what the tax basis is. So generally the estate tax savings does outweigh the income taxes, but we thought just to make sure, let's run some spreadsheets and check the math. So here, the first 12 years, there's not going to be any income taxes, because if you die during the retained term, the house is going to be included in your estate, and you would get a step up in basis at that time. So this would be zero. The estate tax savings is zero, so no harm, no foul there. If they live for 20 years, the home growing at 3% might be worth 1.7 million. My basis of $700,000 equal to my basis that I transferred in by gift. So I have $1 million gain. If the 20% rate applies, you know, I pay maybe $440,000, or sorry, $300,000 of taxes, and I look at my estate tax savings at that point in time of around $700,000. So I'm still in the green here from an estate tax side. Even if the 40% rate applies and I have to pay 40% of income taxes, I still come out in the green from estate tax savings when I look at the difference between the two. So we've added this now to the Cupert chart. We're going to try to incorporate the buttons to make this work seamlessly with the estate tax savings side. So then you can analyze, okay, even if I do lose the step up in basis, how does that play and interact with the estate tax savings? Now, I think the other argument here, Alan, if you want to address this, is these Cuperts are likely going to be set up as grant or trust if they're done before the enactment of the statute. So you may not even lose your step up in basis.
Unless there's a act by Congress, in my opinion, you still get the step up in basis from a defective grant or trust. Now, I believe that most tax authorities disagree with us on that, but there are tax authorities, including Howard Zaritsky, Jonathan Blottmacher, and others, who have written with, in my opinion, clear vision that you do get the step up. Mm-hmm. So clients say, well, how will I know if I get the step up? Well, when you sell the house, you'll talk to your tax advisor and decide whether you want to report it as if you got the step up at fair market value on death. There's no 1099 that you have to issue yourself to take the step up. It just simply happens. So, Brandon, great job on this. I'm looking forward. We have to get Grace's boyfriend to put the arrows in for us. So I'll be extra nice to Grace next week so that we can get that done. If anyone wants this spreadsheet, if it was not attached today, just email us for Cupert spreadsheet and we'll be glad to provide it. So I'm having fun here with my Tiger tables. We went through Cuperts, we went through installment sales. What else should we go through?
I think the GRAT is really interesting because it actually has some financial results that come around with it. So let's go through that one.
Okay, so a GRAT is a grantor retained annuity trust. You can still do them until President Biden signs the new bill. And the way it works is this: I put $1 million into a GRAT. Instead of giving Brandon a bonus this year for $1 million, I put $1 million into a GRAT. And it's a 5-year GRAT. It's going to make payments back to me for 5 years. And Brandon, what do the payments need to be in order for them not to be considered to have made any gift whatsoever?
The nice thing about Tiger tables here is if you just click in this annual annuity amount, you can set it to any amount that you would like, and it will give you. So if I say I'm only going to get $100,000 back, it will tell you, okay, you've now made a taxable gift of $514,000 because you're not getting back equal to what you've received. But it also tells you, okay, zeroed out term annuity. If I want to zero out the gift, it gives me the amount of the annuity that needs to be paid, so that at the end of this 5-year term, the value at the end of the trust, according to the IRS, is zero, and I've made zero taxable gift. But what happens if the assets earn 6%? I've still not made a taxable gift because the IRS values these annuity payments based upon this low 1% interest rate. So if I'm earning 6%, then the value at the end of the trust term might be $176,000. So we can look at the results here. We put the $1 million in, we're assuming 6% growth. It's got to pay me back the annuity of $206,000. So at the end of year one, the balance is $850,000. So we continue through the 5 years, the 5 years of annuity payments. My closing balance at the end is $176,000 and change that can pass free of estate and gift taxes. So the GRATs can work out really well. The other thing you can do here is you don't have to pay a level annuity. It can increase each year by as much as 20%. So it can be front loaded. And because of that, we would then start the annuity here at the zeroed out level of $138,000. We'll recalculate our numbers. I made a zero taxable gift, but now since I'm backloading the payments, instead of $176,000 left, I have $196,000. So just allowing more growth to occur before the annuity payments are made. Still a zeroed out gift, but end results are a little bit better because of that deferred payment right.
Right. So if you have a client that's already used their 11.7 million and they want to do more, and you're concerned about doing an installment sale because you're concerned that the value you're going to use could cause gift treatment, a GRAT zeroes out, and what happens is if the IRS comes looking for you and says, wait a minute, you said you put an asset worth $1 million into this GRAT. We think it was worth $2 million. Well, then what happens is you don't owe any gift tax. What happens instead is you just simply have to double the payments that come back out from the GRAT to the client. So there's really no gift tax risk. The GRAT remainder, what is left in the GRAT after the 5th year in our example, will have to be subject to estate tax in the next generation's estate. You can't safely allocate what we call generation skipping tax exemption to a grant of retained annuity trust. But where the GRAT can throw off amazing numbers is when you have an interest in a partnership or an S corporation that you can put into a GRAT. For example, if you have an S corporation that earns $1 million a year of K1 dividends, and you take 30% of that, $300,000 a year, the company's worth, say, 6 times earnings. So 300,000 times 6 times, it's worth $1.8 million. Take about a 1/3 discount, it's worth $1.2 million. So you put $1.2 million worth of stock into the GRAT. The GRAT's going to receive $300,000 a year in payments. And what does that look like in payments then? $1.2 million goes into the GRAT, and the GRAT is going to pay back 5 equal payments of $247,000. So the GRAT has received $1.2 million worth of stock and is receiving $300,000 a year. It uses $247,000 to make the GRAT payment to the client. It keeps $53,000 a year. At the end of the 5th year, it has over $250,000 plus what it reinvests the $250,000 for, plus it still owns 30% of the stock. And it is risk-free from a gift tax standpoint. So the value of this trust, Brandon, you're fast. This is great. The value of the trust at the end of the 5th year is $1,632,000. And that's why we are going to so miss GRATs if they are not available after a new law, because the new law would annihilate GRATs that are signed and funded after the new law is passed. And the intent of the House of Ways and Means Committee is that even if you have a pre-existing GRAT, when President Biden signs the bill, if the GRAT pays out anything other than cash, and that asset that it pays out has appreciated in value, then that will trigger capital gains. Brandon, do you want to better explain that?
Yeah, so the problem with the GRAT too is, cash flow. In this situation, where there's income and enough growth to support the annuity payment, it might be possible, to still potentially use the GRATs, although if it's done after the statute, it's going to be a grant or trust and included in your estate. So that's just not going to work. The other problem too is for pre-existing GRATs that were funded even prior to the effective date. If they do not have cash flow to support the annuity and have to transfer appreciated assets in kind, then that transaction is no longer going to be disregarded and could trigger income taxes on that transfer and to satisfy the annuity payment. So that's going to be another interesting aspect of this is now after the effective date, even for grandfathered trust, transactions with grantor trust are no longer disregarded. So that could cause issues with GRATs as well.
Okay, we have a question here from Stephen. Stephen, thank you very much for watching. If I sell assets to an intentionally defective grantor trust and the note is for my life expectancy of 21 years, after 19 years or 20 years, can the original note be exchanged for a skin? Now, I think Stephen is about 60. So Brandon, what would the interest rate have to be for an 81-year-old to do a skin? So here we go, back to Tiger tables, setting the interest rate at 1%, which is the present 75/20 rate, 1.76% note, 81-year-old, term of the note you're solving for has to be 8 years. Nope. Oh, you just keep guessing until it tells you.
I'm just guessing, yeah.
Oh, okay, that's cool. That's good. That's called interpolation. Wow. Okay. So the interest rate for an 81-year-old only has to be 6.75% for an 8-year.
That's the premium, so that would be added to whatever the term is. So I think we could use the short-term rate since it's less than 9 here. So this would come down to, I think it's 0.89, if I remember correctly, somewhere around in there. But yeah, so around 8.5.
So Stephen, that answers your question, and I'll be adding this to your bill. All right. Brandon, was there anything else you wanted to make sure we covered today during the primary program? I'm back to.
No, I think we were going to talk a little bit about GRATs and Cuperts, but I think using Tiger tables covered those well enough. So I think we're good on my end.
Okay, very good. Well, let's do one final polling question. What's true about grantor trusts? A, transactions between the trust and the grantor are disregarded. That's true right now, won't be true after the new law. B, grantor pays income tax for the trust. Yep, that's true now, and that'll be true under the new law if it passes, if the trust is grandfathered. C, proposed legislation would negatively impact use. That's correct. And D, all of the above. Okay, Sheldon, thanks for saying thank you. It's always a pleasure to hear from you. We welcome any questions, comments, and suggestions. Remember, Brandon's taller than me, but we haven't IQ tested, so we don't know if he's smarter than me yet. Have a fantastic rest of your day. Brandon, any final comments?
No, I'm good.
Beautiful. Thanks very much.